There's a moment in every single flight when you stop thinking about the airplane as just a machine and you start thinking about it as a massive network. You've got air traffic control handing you off from one sector to the next. You've got navigation satellites feeding real-time position data. You've got dispatch actively watching weather, fuel, routing, and alternates. And you have airports, runways, gates, ground crews, and payment systems all working flawlessly in the background. And when everything works exactly as it should, the passenger never thinks about a single piece of it. They just tap a card, buy a ticket, grab a coffee, board the airplane, and go. That is the ultimate beauty of a great network business. The customer sees simplicity, the business sees volume, and the investor sees a beautiful toll road. Today, on day 23 of 30 of Under the Cowling, we're looking directly at Mastercard, ticker symbol MA, one of the most powerful payment networks in the world. And the core investment idea is simple. Every single swipe pays a toll. Mastercard owns one of the most valuable payment rails in the entire global economy. Now, it is crucial to remember that Mastercard is not a bank. It does not usually take on the credit risk. It does not need to fund the actual loan. It does not need to own the merchant, and it does not need to convince you to carry a monthly balance. Instead, Mastercard sits right in the dead center of the transaction ecosystem, seamlessly connecting cardholders, banks, merchants, processors, and governments, and it earns a small, reliable fee every single time money moves across its network. That may sound simple, but simple is definitely not the same thing as easy, because global payment networks are incredibly difficult to replicate. To even compete, you need global acceptance, deep bank relationships, universal merchant trust, advanced fraud prevention, heavy cybersecurity, regulatory compliance, massive scale, constant uptime, and global brand recognition. In aviation terms, Mastercard is not just one individual airplane. It is closer to the entire air traffic control system for global commerce. It does not need to own every aircraft, and it does not need to own every airport. But whenever global commerce traffic moves, its network matters. So today, we are going under the cowling on Mastercard. We'll look closely at the business quality, we'll test the competitive moat, we'll analyze the valuation, and most importantly, we'll ask the exact question every disciplined investor needs to ask: is Mastercard still a high-quality compounder, or is the stock already priced for absolute perfection? This is Captain Pierce. Welcome back to SkiesCapital. Think clearly, invest better. The best businesses often look incredibly boring from the outside, but under the cowling, Mastercard is a high-margin, asset-light, global toll road. The question isn't whether this is a great business. The question is whether the price gives investors enough runway. Let's go. Before we talk valuation, the moat, or whether Mastercard is a buy today, we need to understand what this business actually does. And the first thing to know is this: Mastercard is not a bank. It does not issue the credit card in your wallet. It does not lend you money. It does not take deposits. And it does not earn interest from cardholders the way a traditional bank does. A lot of people look at Mastercard and think credit card company. But Mastercard is really a global payments network. Think of it like air traffic control for money. When you fly across the country, you usually don't think about the complex handoffs happening behind the scenes. Air traffic control, dispatch, weather tracking, routing, and ground systems are all working seamlessly together. If the network functions properly, the passenger never notices. Payments work the exact same way. When you tap your card at a restaurant, a gas station, or online, the transaction feels instant. But behind the scenes, that payment has to be authorized, routed, cleared, and settled. Mastercard's network is what helps make that happen. It connects consumers, merchants, issuing banks, acquiring banks, processors, and businesses across more than 220 countries and territories. And as those transactions move across the system, Mastercard earns network and service fees. That is why I call this business a payments toll road. Mastercard does not need to own the bank. It does not need to own the store. And it does not need to carry the loan risk. It simply benefits whenever more money moves across its rails. And the scale is enormous. In fiscal 2025, Mastercard processed approximately $10.6 trillion in gross dollar volume, generating about $32.8 billion in net revenue, up roughly 16% year over year. Then, in the first quarter of 2026, net revenue was about $8.4 billion, also up 16%, with an adjusted EPS of $4.60. The business has two main revenue engines. The first is the core payment network, fees tied directly to transaction volume, cross-border activity, and switch transactions. The second is value-added services and solutions, Things like fraud prevention, cybersecurity, data insights, authentication, processing, and open finance. So, the investment question is not simply, do people still use cards? The better question is, as global commerce becomes more digital, more cross-border, and more connected, does Mastercard continue to sit in one of the most valuable control towers in the global payment system? That is exactly what we'll test next as we go under the cowling. Now that we understand what Mastercard actually does, the next question is business quality. And this is where Mastercard starts to look like a high altitude business. In aviation, altitude gives you options. A great business works the exact same way. High margins, strong cash generation, recurring transaction volume, and disciplined capital allocation give a company far more flexibility whenever conditions get turbulent. So, let's run the pre-flight checklist. First, revenue mix. Mastercard has a highly resilient two-engine model. The core payment network represents roughly 59% of fiscal 2025 net revenue, which is tied to payment volume, cross-border activity, and switched transactions. The second engine is value-added services and solutions, or VAS&S, at roughly 41% of revenue. This matters because the services layer is growing faster than the core network, expanding into fraud protection, cybersecurity, data analytics, digital identity processing, and open finance. It's becoming much more than a payment toll road. It is becoming deeper infrastructure for global commerce. Second, operating margin. In the first quarter of 2026, Mastercard reported a 58.4% GAAP operating margin and an elite 60.8% adjusted operating margin. For the full year of 2025, margins were 57.6% GAAP and 59.2% adjusted. Those are exceptional numbers, showing a capital-light, scalable model where incremental volume can flow through the network with very high operating leverage. Third, cash conversion. Mastercard generated about $3.0 billion in operating cash flow in the first quarter of 2026. The cash engine is remarkably clean because Mastercard does not carry inventory, does not manufacture physical goods, and does not run a traditional lending book. Fourth, capital allocation. In the first quarter of 2026, Mastercard repurchased about $4.0 billion of stock and paid roughly $0.8 billion in dividends. This is not a high-yield dividend story. It is primarily a compounding and buyback story. And with the recent BVNK deal, Mastercard is also investing directly in stablecoin and digital payment infrastructure, trying to extend its relevance into the next generation of payment rails. Looking across this entire checklist, the foundational business quality is incredibly strong. Diversified revenue, elite margins, robust cash generation, and disciplined capital allocation. So, the key question is not whether Mastercard is a quality business. The key question is whether the stock price already reflects that quality. Now that we've looked at why Mastercard is such a high-quality business, no investment is ever truly cleared for takeoff without checking the weather. So, let's dive into the bear case. What exactly could go wrong? First is cross-border and macroeconomic pressure. Mastercard's cross-border volume grew 13% in the first quarter of 2026, which is healthy, but international travel and global commerce carry the network's most attractive economics. If travel slows, consumers pull back, or a recession hits, it will directly pressure one of Mastercard's highest margin revenue streams. Second is regulatory and antitrust pressure, a risk that never fully goes away. Interchange caps, routing rules, merchant litigation, and fee regulations remain constant overhangs. In the United States, the Credit Card Competition Act represents a real tail risk because it could force alternative routing competition into credit card transactions. Mastercard doesn't keep the interchange fee like a bank, but regulation pressures the entire ecosystem, affecting issuer economics, rewards, merchant behavior, and network profitability. Third is stablecoin and fintech disintermediation. Real-time payment networks like FedNow, UPI, and Pix prove that governments are building viable alternatives. Stablecoins add another disruptive layer, moving money faster, cheaper, and completely outside traditional card rails. I covered tokenomics and future payment rails in deeper detail during my tokenomics series, which I will link below. For Mastercard, the threat is simple. New rails may not kill the company, but they will change where the global profit pool moves. That is exactly why the BVNK deal matters. Management is trying to build a bridge to future rails before they become a larger threat. Fourth is valuation risk. Mastercard is a fantastic enterprise, but you can still underperform if you overpay. The stock carries a premium multiple, meaning strong growth and execution are already priced in. From the cockpit, the headwinds are clear. Cross-border sensitivity, regulatory pressure, new payment rails, and valuation risk. This doesn't cancel our flight, but it means we keep checking the instruments before assuming clear skies ahead. Now that we've looked at the risks, let's turn the airplane back into the tailwinds. This is the bull case, and exactly why Mastercard still has an immense amount of runway ahead. First is value-added services and solutions, or VAS&S. Mastercard is no longer just a basic card network collecting flat transaction fees. It is building a massive software services layer around fraud prevention, identity, cybersecurity, data analytics, processing, and open finance. In the first quarter of 2026, VAS&S revenue grew 22% year over year, expanding faster than the core business and representing roughly 40% of total net revenue. This makes the enterprise incredibly sticky. The more Mastercard helps banks, merchants, fintechs, and governments manage fraud, authentication, and security, the deeper those relationships become. In aviation terms, this isn't just selling a ticket. It is becoming part of the dispatch system, the navigation system, and the pre-flight safety checklist. Second is stablecoins. While they could potentially bypass traditional card rails in certain edge cases, the bull case is that Mastercard sees this shift coming. Their recent BVNK acquisition brings stablecoin infrastructure entirely in-house, in a deal valued up to $1.8 billion. Management is actively building a bridge between traditional payment rails and blockchain settlement. So, stablecoins are not just a threat, they represent massive future optionality. Third is agentic commerce. Mastercard Agent Pay is designed explicitly for a world where AI agents search, compare, and purchase directly on behalf of consumers. The company is already collaborating with industry titans like OpenAI, Microsoft, Cloudflare, and PayPal. The core idea here is simple. If AI agents are going to transact, they still require trusted payment rails, real-time authentication, fraud protection, identity permissioning, and secure settlement. That keeps Mastercard positioned as one of the primary control towers in the next layer of commerce. Fourth is valuation and capital return. Mastercard is never cheap, but relative to its own history, the valuation is not as stretched as it has been in the past. Meanwhile, management continues to return capital aggressively. In the first quarter of 2026 alone, Mastercard repurchased about $4.0 billion of its own stock. So, the bull case is clear. A faster growing services layer, stablecoin optionality, strategic AI commerce positioning, and a powerful buyback engine. From the cockpit, that means the aircraft still has runway, but the key remains strict valuation discipline. The underlying business may be excellent. The final question is whether today's price gives investors a large enough margin of safety for the flight ahead. Now let's move directly to the instruments check. This is the exact point where we stop looking at the high-level story and start checking the actual gauges on our dashboard. For Mastercard, the foundational business quality metrics remain exceptionally strong. Start with revenue. Over the last 4 quarters, Mastercard produced steady net revenues of roughly $8.1 billion, $8.6 billion, $8.8 billion, and $8.4 billion in the first quarter of 2026. This minor sequential pullback from the fourth quarter to the first quarter is completely normal post-holiday seasonality. The far bigger point is that the company maintains a highly reliable annualized revenue run rate well above $30 billion. In the first quarter of 2026, Mastercard delivered an adjusted operating margin of 60.8%, which is flat out phenomenal. This asset-light network allows massive transaction volume to continuously scale across its rails without requiring heavy incremental capital. That underlying structural reality is exactly why their operating leverage is so powerful. Consequently, adjusted EPS surged 23% year over year to $4.60 per share, proving that their revenue growth, elite margins, and share buybacks are working in perfect harmony. Those buybacks are highly meaningful, with Mastercard repurchased roughly $4.0 billion of its own stock in the first quarter alone. This is not a high-yield dividend play. It is a compounding machine that generates massive excess cash, reinvests in core tech, funds strategic acquisitions, and systematically retires outstanding shares. Regarding ROIC, or return on invested capital, their returns remain far above their WACC, or cost of capital. I am avoiding a precise percentage because decades of aggressive buybacks can heavily distort the capital base depending on the calculation. But the clear takeaway is that Mastercard earns massive returns above its costs, the ultimate sign of a durable economic moat. Meanwhile, value-added services and solutions, or VAS&S, grew 22% year over year, making Mastercard deeply embedded via enterprise fraud prevention, cybersecurity, and data analytics. Finally, high-margin cross-border volume expanded 13% on a local currency basis as international travel stays resilient. Across the entire dashboard, the picture is clear. Revenue is massive, margins are elite, earnings are scaling, buybacks are heavy, and returns remain far above capital costs. From the cockpit, this aircraft is operating flawlessly at high altitude, but we still must ask what the market is already pricing in. Now let's move directly to our fleet comparison. Before deciding what Mastercard is truly worth, we must compare it against the other aircraft in the payments fleet, because not all payment companies are built the same way. Mastercard, Visa, American Express, and PayPal all live in this exact same ecosystem, but under the cowling, they are entirely different businesses. Start with Mastercard and Visa. These are the two cleanest, pure-play payment network businesses on earth. They carry zero credit risk. Like a traditional lender, they do not need to fund receivables, and they don't own the merchant. They simply sit right in the middle of global commerce, earning steady transaction fees as money moves across their rails. That incredible structural advantage is why both command premium valuations. Currently, Mastercard trades around 28 to 29 times trailing earnings and roughly 24 to 25 times forward earnings. Visa screens slightly cheaper on a forward PE basis, with an even higher operating margin sitting around 65% plus. So, Mastercard is not an obvious bargain against Visa, which remains its closest true peer. But Mastercard's unique bull case is its faster growing services layer, VAS&S, plus its strategic positioning in stablecoins through BVNK and Agentic commerce. With Mastercard, you aren't just buying a legacy card network. You are buying a massive software services engine and future payment optionality. Now, look at American Express. AXP is an incredibly high quality brand, but its model is completely different. It operates as a premium card issuer and a lender, meaning it carries real credit risk on its balance sheet. If the economy weakens, loan losses and credit defaults matter far more to their bottom line than they ever will to Mastercard. Meanwhile, PayPal screens noticeably cheaper, but it functions more as a checkout wallet and a corporate turnaround story. It has global scale, but it simply lacks the impenetrable global network moat of a Mastercard or a Visa. Ultimately, the fleet comparison is clear. Mastercard and Visa remain in an absolute class of their own for moat durability, elite profit margins, and ROIC. Visa may look a little bit cheaper today, but Mastercard offers more visible upside from its high-growth value-added services. The premium valuation isn't random. The market pays up because this is one of the highest quality business models in existence. The final question we have to answer is simple. Does this premium multiple still give investors enough runway? Now we move directly to the Altimeter check. This is where we stop asking, is Mastercard a great business? And start asking the more vital investor question, what are we actually paying for that quality? Because in investing, altitude matters. A great business can still turn into a poor investment if you buy it at the wrong elevation. On a trailing basis, Mastercard trades around 28 to 29 times earnings. That is not cheap, but it sits below where the stock has historically traded, with the 5-year average closer to the low to mid 30s. The forward PE multiple is even more important. On fiscal 2026 consensus earnings, Mastercard trades around 24 to 25 times forward earnings, with expected EPS growth of roughly 15%. So, the market is still assigning a premium multiple, but it is not the same premium it commanded in the past. In other words, this isn't bargain bin cheap, but it is far more reasonably priced than usual for a business of this quality. The dividend yield is only about 0.65 to 0.70%. So this is definitely not a high income stock. The real capital return engine is the share buyback. Mastercard generates immense cash, requires relatively little capital to grow, and returns meaningful excess cash through aggressive share repurchases. Then we have ROIC, or return on invested capital. I am not using a precise ROIC number here because aggressive buybacks can heavily distort the invested capital base depending on the calculation. But the conclusion is clear. Their ROIC sits far above their WACC, meaning Mastercard earns returns well above its cost of capital, one of the strongest signs of a durable moat. So here is the captain's call. At 24 to 25 times forward earnings, Mastercard trades below its own historical range while still showing premium business economics. Expected EPS growth around 15%, adjusted operating margins above 60%, aggressive buybacks, and an asset-light model. This is not a deep value stock. It is a high-quality compounder trading at a more reasonable altitude than usual. The key is not to chase it blindly, but to ask whether today's price gives investors enough runway for the next leg of the flight. Now let's move directly to our approach and entry framework, where we turn our business quality, risks, and valuation work into a highly practical entry price strategy. With a dominant network like Mastercard, the question is never whether it's a good business. It clearly is. The far better question for investors is, at what exact price does the risk-reward profile become genuinely attractive? To map this out, I'm breaking the stock down into 4 distinct zones based on our current elevation. First is the turbulence risk zone, which applies to anything above roughly $550. At that elevated level, your margin of safety gets razor thin. You are paying a heavy premium multiple and assuming flawless operational execution. So this is simply not a place to add capital aggressively. Second is fair value, tracking from $490 to $550. This is the current zone, with the stock recently hovering near $499. At this elevation, it's a reasonable hold for long-term investors. Not cheap, but fairly priced for an enterprise with elite margins, heavy buybacks, and a highly durable global network. Third is the attractive zone, ranging from $440 to $490. Below $490, the setup gets much more interesting as quality and valuation start to line up beautifully, assuming the core thesis remains entirely intact. That caveat is critical. A broader market pullback creates an opening, but if the competitive moat is actually breaking or growth is structurally slowing, a lower price is just a value trap. Fourth is the compelling zone, anywhere below roughly $440. This is your high conviction entry point, offering a massive margin of safety relative to the sheer quality of the network. To keep our instruments calibrated, these specific zones are based on fiscal 2026 EPS estimates of roughly $19.50 to $20, translating to forward valuation bands of 22 to 27.5 times earnings. Remember, this is an operational entry framework, not a rigid price target. A price target tries to blindly predict where a stock will go, while an entry framework tells us exactly how to behave at different altitudes. Recently, Mastercard has traded between $466 and $503, bouncing right between our attractive and fair value tiers. My captain's call is straightforward. The thesis is completely intact and quality remains world-class. But at $499, it's a reasonable valuation, not a bargain. I wouldn't chase it above $550. I'm comfortable holding between $490 and $550. I get highly interested below $490. And below $440, it becomes a compelling accumulation zone. Successful investing requires patience, absolute valuation discipline, and a clear flight plan before deploying new capital. Now let's move directly to our monitoring checklist, the part of the flight plan where we ask the ultimate oversight question. What exactly do we need to watch most closely after this quarter? Even when an investment thesis looks incredibly strong, disciplined investors always require clear checkpoints. For Mastercard, I am watching four main items on our dashboard. First is cross-border volume recovery. In the first quarter of 2026, cross-border volume grew 13% on a local currency basis. That's an undeniably healthy number, but it sits below the 14 to 15% range we witnessed throughout 2025 because international travel and global money movement carry Mastercard's highest margin economics. We must watch whether this volume cleanly reaccelerates or if macroeconomic headwinds cause it to slow down further. Second is value-added services and solutions, or VAS&S. This crucial engine now accounts for roughly 40% of total net revenue, growing at an impressive 22% as reported. This software layer handles enterprise fraud prevention, cybersecurity, and open finance, making Mastercard deeply embedded with banks and governments. Moving forward, we need to verify that VAS&S comfortably maintains its high teens growth momentum. Third is BVNK integration and stablecoin revenue. This acquisition proves management isn't ignoring alternative payment rails. While stablecoins pose a long-term threat to traditional card networks, they offer massive future optionality if Mastercard successfully bridges legacy infrastructure with blockchain settlement. We need to see real-world customer adoption transition from a corporate press release into hard revenue. Fourth is the adjusted operating margin. Mastercard reported an elite 60.8% margin in the first quarter of 2026. Going forward, the true test is whether they can hold this 59 to 61% baseline while aggressively investing in AI commerce and new tech initiatives. Any sustained drop below 58% would signal unexpected pricing pressure or cost drag. From the cockpit, these are our mandatory waypoints. The thesis remains perfectly intact today, but these are the exact instruments I will be monitoring to ensure Mastercard stays firmly on course. Now we're on final approach. After going under the cowling on Mastercard, my thesis status is simple. It is completely intact. This remains one of the highest quality payment businesses in the world. It is not a bank, it does not rely on deposits, and it does not carry traditional lending risk. It operates one of the most important payment networks in global commerce, inherently benefiting as global spending moves more digital, cross-border, and data-driven. The business quality is crystal clear. The first quarter of 2026 delivered 16% revenue growth, a 60.8% adjusted operating margin, and about $4.0 billion of share repurchases. That is a powerful combination. Elite profit margins, robust cash generation, a capital-light model, and a management team continuing to return capital while aggressively investing for the future. But this is not a blind buy at just any price. Mastercard is a premium business trading at a premium multiple, around 24 to 25 times forward earnings. I would call the valuation reasonable, but certainly not cheap. The thesis is intact, but investors still need to check the instruments closely. We need to make sure cross-border volume recovers its momentum. Value-added services and solutions keeps expanding. The BVNK and stablecoin strategy moves from corporate press release to execution, and operating margins stay structurally strong. So, my final captain's call is this: Mastercard remains a best-in-class compounder with a durable moat, elite margins, strong buybacks, and exceptional long-term optionality in services, stablecoins, and agentic commerce. For long-term owners, the flight plan remains fully intact. For new capital, I would stay disciplined. The stronger add zone begins below $490, and the opportunity becomes far more compelling below $440, assuming the long-term fundamentals remain solid. Remember, encountering turbulence is not automatically a reason to change your flight plan, but you still have to keep checking your instruments. If this breakdown helped you think more clearly about Mastercard, please like the video and subscribe to SkiesCapital. And if you want the same pre-flight checklist I use to evaluate every stock, you can download the free Captain Stock Scorecard right now at skiescapital.com/captain's checklist. This has been Captain Pierce with SkiesCapital. Think clearly, invest better, for educational purposes only, not investment advice. Keep the blue side up and safe skies.